Hey everyone, Chris here. Hope you're doing good. So, by Nicole's and David's request, let's analyze the currency pairs of AUDNZD and USD Swiss franc today. Okay, so let's see the AUDNZD on the weekly chart. As we can see from 2011, there was a big drop from 1.3800 right down to parity 1.0000. From 2014 on, the price has been correcting this big fall, and we can see that AUDNZD is ranging. However, recently the lows are consistently climbing, and I've marked this with a yellow ellipse. Fundamentally, the two currencies are pretty square, so we can't say that this is the best to be trading on. You know, ideally, the solid choice would be to trade a strong currency with a weak one. But if you want to trade with AUDNZD regardless, I would suggest choosing the long side. In other words, 1.15 may come into picture soon. For now, I would close out parity. Fundamentally, AUD may be a tad bit stronger than NZD. Australian economic growth has picked up in 2017, we can see, and the labor market has tightened, helping the currency to recover from the slump seen during the commodity price downturn, which forced the Reserve Bank of Australia to cut the Aussie cash rate to a record low of 1.5%. Evolving expectations of where the cash rate goes next and when they eventually move will be key to the Aussie dollar outlook in 2018. Interest rate expectations themselves will be determined largely by what happens in the Aussie labor market, especially around wage growth. So our next currency is USD Swiss franc by David's request. It's really similar to AUDNZD. We're correcting a big fall here as well. The big benefit, however, of this currency pair is the swap. USD's 1.5% interest versus CHF's negative 0.75%. So beside the exotic pairs, this major currency pair is what pays the best interest rate. So let's switch to the daily chart. As we can see, this pair is not easy since it bounces around heavily. I think that this is unsuitable for textbook trading. You know, I'm thinking of when you set a point where you take on a position, and by using a tight stop loss, you win your risk back at least three times over. I think trading on this pair only makes sense if you're looking at long term and use a minimum amount of leverage. But time works for you here. You receive your interest due to the swap and you close your position on a realistic target price. For me, USD Swiss franc is long by all means, both fundamentally and technically. While I go back to the weekly chart, for me this means that I mark out the zone where USD is probably oversold versus the Swiss franc. This region would be the zone between 0.95 and 0.94 for me, right here. As I mentioned, it's impossible to give a pip-specific value where the price turns around, especially with this currency pair. So, I would take on a long position within this zone with a leverage of 1-to-1. For accounts managed by us, even this would be too big of leverage. Usually we take up positions from 1 to 0.1 and from 1 to 0.3. So, if you have $100, the amount of the taken up position would be $10 to $30. Target price would be around 1.03 and 1.01. In other words, profit up until the target price would be about 800 pips. This would potentially bring approximately an 8.5% yield, not counting the interests. And I know many would scoff at this, saying that it's nothing. Well, maybe, but if you have a multi-million-dollar account, it's not that bad, you know? You can go all out with a $10,000 account, taking on too big of a risk. It's not that big of a deal. But, you know, try going hard like that with an account that's not yours. You'll probably lose your job instantly and maybe even get some jail time. Anyway, I'm ranting a bit, sorry. But the point is that with us, most of the positions are not big compared to the capital. So, I hope you enjoyed the video, and thanks a lot for tuning in. Until next time, take care.